So let's go to IAS 10, events after the reporting period. Let's see if we can shift that a little bit. Events after the reporting period. Yes, primarily what is happening is that we are going to prepare our financial statement up to the year ended of the entity. Sounds good? We're going to be preparing our financial statement to the year ended of the entity. So if the entity's year ended is 31st October, then we prepare the financial statement to 31st October. If the year ended is 31st December, we prepare the financial statement up to 31st December. If the year ended is 30th April, then we have to prepare the financial statement up to 30th April. Now, it means that technically we are going to be closing the books once we hit these dates. Okay, the books are going to be closed for the year. Now, if we close the books for the year, does that mean that is all? The answer is no. Why? Because after the reporting date, there are a couple of transactions that are going to be taking place. The question we ask ourselves is, between the year ended and the time that financial statements are authorized for publication, when the transactions take place, do we have to come back and amend our financial statement or not include it in the financial statement at all? So let's say, for instance, our year ended is 30th April every year. But then the financial statements are going to be, so this is our year ended. The financial statements are going to be published or publication of financial statements. So financial statement publication is going to take place, let's say, 1st August. 1st August. Let's say that's where publication of financial statement will take place. 1st August. The question is, between 1st May to 31st July, the transactions that take place, how do we deal with them? Should we include them in the next year financial statement, or we should bring them back to the current financial statement? That is what we want to discuss when it comes to events after the reporting period. So the events after the reporting period are simply the events that are occurring after the year end and before financial statements are authorized for publication. Are you okay with that explanation? The transactions occurring after the year end and the dates that the financial statements are authorized for publication. So in the context of my scenario here, if our year ended is 30th April and financial statements are authorized for publication on 1st August, then the transactions that take place between 1st May and 31st July will become what we call the events after the reporting period. That is basically the idea about that. The events after the reporting period. So I'm going to go to my slide and then give you a couple of things generally in that particular case. So, like I said, these are transactions occurring between the year end and the dates that the financial statements are authorized for issue or authorized for publication. That is what we mean by the events after the reporting period. Now, these transactions occurring in my example here between 1st May and 31st July can broadly be divided into two. Okay, so the events can be divided into two. We have what we call adjusting events and then non-adjusting events. So the events that are occurring between the year end and when financial statements are authorized for publication can broadly be divided into two: adjusting events and non-adjusting events. Adjusting events and non-adjusting events. So, what do we mean by adjusting events? What do we mean by non-adjusting events? What do we mean by this? Now, generally, the definition of this stems from the relationship that the transaction has with events at the reporting date. In other words, if the transaction taking place is providing us with further information that existed at the reporting date, then it becomes an adjusting event. But then if the transaction that is taking place doesn't give us any further information about something that existed at the reporting date, it becomes a non-adjusting event. So basically, there are two things that we have to look out for about whether something can be treated as adjusting or non-adjusting. Two key variables. The first variable of the distinction is, number one, does it provide further information to a condition existing at the reporting date? Okay. Does it provide further information to a condition existing at the reporting date? Existing at the reporting date. That's the first variable, and that is the default variable usually when we are dealing with events after the reporting period. That's the first question we ask ourselves. Does it provide further information to a condition existing at the reporting date? If the transaction in question is providing us with further information, further condition, further relationship, or further information about the transaction that existed at the reporting date, then that transaction will be treated as an adjusting event. I hope you're getting the idea. But if it doesn't provide us with any information existing at the reporting date, then it will be treated as what? A non-adjusting event. The next thing is that, does the event impact on the going concern of the entity? Or will the transaction affect the going concern assumption of the entity? Now, stay with me very carefully. That is the second key variable that we look out for. Now, what does that mean? You see, there are certain transactions that are traditionally non-adjusting events, all right? But if they impact on a going concern of the entity, then they become adjusting events. So you remember that under the conceptual framework, the underlying assumptions for the preparation of the financial statements are the accrual basis and then the going concern. Now, the going concern simply states that when preparing the financial statement, an entity must assess whether management must assess whether the entity can operate in the next 12 months. Okay, normally you will hear into the foreseeable future, but technically into the next 12 months. So the question is, can the entity operate into the next 12 months? If the answer is yes, the entity can operate in the next 12 months, then we prepare the financial statement on a going concern basis. However, where the entity cannot operate as a going concern into the next foreseeable future, then the financial statement must be prepared on a break-up basis.